Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Happy Canada Day, Danielle.
Yes, and you, Jim.
And happy graduation day for your son.
Yep, my last one's finishing high school, Jim. This is a definite landmark.
Janet Yellen, the headlines everywhere, she pronounced that we should not expect an economic crisis in our lifetime. Is that a silly statement for anyone to make?
It's embarrassingly silly, actually. I think it's, I'm just shocked repeatedly at the inept obtuseness of people with great learning and great academic achievement and in these positions of great influence in policy. And I guess we shouldn't be surprised, because as I wrote on the blog, they didn't see any of the crisis coming, even though they talk about these financial meltdowns being a 3 standard deviation event that should only occur once in every 100 years, and yet they've recurred repeatedly in the last 30. It's a function of the leverage that has been poured into the system in everything from, central bank money, pumping liquidity, debt on debt, financial leverage, derivatives, margin accounts, borrowing at every level of society. This has just created this system that is, turns on a dime and explodes to the top and then it crashes to the bottom. And it's, this is the high beta rich. This is the predicament that we are in today. And we have these policymakers who, Yellen was there under Bernanke, was there under Greenspan. So since 1987, we've had these people that have sort of taken the helm, taken hostage the nations with their ideas about expansionary monetary policy and how that's supposed to be such a wonderful gift. But in fact, all it does is reach into the future, bring forward consumption, and leave big holes that we're now driving into. Right? We are falling into the potholes in terms of demand, global growth, misallocation of resources, wasted money left and right. And here she is with straight face saying that she thinks, the system is that much more robust today than it was in 2008, even though we have 69 trillion more debt globally, even though, by every measure we're more feeble and fragile. I mean, they did these bank tests this week, which were farcical. They were looking at what would happen if there was a increase in unemployment to 10%, but, we could have a much higher impact, a negative impact, because we have such low labor participation rates today. So it's all these faulty narratives that they don't look at the knockoff effects of when these bubbles burst. And of course, everyone is shocked. And yet, if you look at that chart that I put on today of the experience since 1987, it's really, it's breathtaking, the leverage in the world, which means the risk, the downside, the mean reversion, all at unprecedented levels. And then here you have this figurehead, lady saying, she doesn't think we're going to see another financial crisis and probably not in our lifetime. And, it really undermines any confidence, but frankly, I didn't have any to begin with, because I've been paying attention to this stuff for, well over 20 years now through this manic episode. And, we'll just keep paying the price, and the next wipeout will be, a mystery, a shock, like a meteorite coming from outer space, instead of the natural fruit and product of the inflationary policies they've taken to pump up asset prices.
Well, they seem to be obsessed with having inflation at 2%. or so. Why do we need inflation at all?
Well, yeah, and they've missed the target repeatedly. The whole crux of it is there's an assumption that if you can keep growing incomes, you'll be able to increase consumption, increase corporate profits every single year. And that's basically what they want. They want a perpetual, steady increase. But in reality, they haven't been able to achieve that 2% inflation target. And in fact, we are, other than pockets of things like food, like tuition costs, like shelter costs, other than those staples, everything else has been in a massive deflationary wave again. Another fascinating conversation or discussion this week came out of the Bank of Canada when you had Mr. Polis saying, he thinks that the half-point cuts that they did in 2015 in response to the oil collapse have, done their job and sort of run their course, to which the Canadian dollar spiked about 1.5% against the U.S. dollar in this expectation of, oh boy, so Polis says, he can basically, he's intimating he's going to increase rates in this environment. But again, if you do the math, we've got oil prices lower by far than they were in 2015 when he was making those cuts supposedly to offset this oil price collapse. Not only that, you've got an economy that is that much more levered than it was 2 years ago. The Canadian household's that much more tenuous. The real estate market that much more fragile and overinflated. At the same time, you've got a protectionist government in the White House. So we are really just like being shot in every limb that we have. And now you've got this central bank, talking the talk. Like they live in this narrative fallacy world where they all go to the Bank of International Settlements meetings in Europe every couple of months and pretend that they're not the same people back home making these, horrendous choices and policies. So they talk there. I liken it to a Monty Python skit where the guy goes to the next window and pretends he wasn't the fellow speaking to you at the one before. But, this is the same crew, and they go there and they have these international meetings where they make proclamations to the world warning and cautioning on the risk of all this leverage and all these inflationary policies and the lack of follow-through on stimulus from governments. And, then they come back home and they pretend like it's all strong and they're going to have to raise rates. I mean, it's just beyond madness, and there's no credibility in it at all. So it's, you see what it's doing is driving currency markets flip-flopping around because nobody knows what in the world to make out of, equity and corporate debt markets, which are just busted and broken, and, trading on algos. More than 75% of the volumes are coming from computers that have been, many of them, programmed with many of these myopic, fact scenarios that the central banks use. They all went to the same school, they all read the same textbooks, and they all run these institutions and then program these, faulty assumptions and biases that they hold into these computer models, who are now pinging off of every piece of news that hits the wire, fake and not. And then you've got the investing public, so to speak, trying to, follow this nonsense and make judgments about where to put their savings. It's a complete disaster. And, of course there's going to be another crisis because nothing was fixed. In fact, if you think about it, leverage just adds speed to the system in, as I say, rapid expansion and rapid implosion. And the more you have, the faster that trigger goes. So of course we're at risk of another, even without all that, even without insane levels of leverage in the world, 9 years past the last recession, we're certainly due for the next one. We've got the third longest expansion, while being the weakest, but the third longest since the 1900s currently. So of course we have to prepare for the next recession or consumption pullback. That's just the way credit cycles move, and credit cycles drive business cycles and drive market cycles. In the end, ultimately, you can throw on all these accelerants, you can throw on gas, but at the end of the day, credit is the fuel that is consumed to make these cycles go. And now we see that the global credit impulse has been negative over the past several months. It's already gone 6% negative relative to global GDP, which was the full extent of the decline we saw in 2008-9. So if you think about that again makes sense. We have that much further contraction to go here. That much less demand is left before us because of what we've consumed on credit in the past few years. So we're due for the next recession. This is likely to be deeper and longer than the last two because we have weak demand, older demographic in the world, lots of supply and capacity overbuilt all over because of all the credit fuel that's been added. And so we have to sort of prepare for that. But instead, you've got all these policymakers who never saw a bad thing coming, Even though they go to the BIS in Europe and have meetings and fret over the bad things coming. You really can't make this stuff up.
We'll have more with Danielle Park right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic Engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Danielle Park. Danielle, would it be bad for Canada to have higher interest rates? Just talk of that boosted the value of the loonie. Would a higher valued Canadian dollar be a good thing as well?
Well, no, I don't think a higher valued Canadian dollar would be particularly helpful to us right now because as I say, the last horse that we have in this race is the hope of an export. And, because we've consumed so much fodder of our domestic strength, we really just have to hope, like many exporting nations, that we can sell a few things. Now, so I don't think a stronger dollar is beneficial. I do think higher rates are necessary. And yes, it will trigger probably a recession, and it will necessitate a slowdown in demand and consumption. Of course, that's natural. That's part of it. That's part of the healing process that's required here for people to pull in, focus on their debt, worry about paying it down for a while, all that. So, of course, that's part of a healthy cycle, and we need to have it. And the perpetuating of these near zero rates is catastrophic for the world. It is causing deficits that cannot be caught back up in pensions everywhere, in institutions that matter, in savings. There's some calculations. I mean, most of the public pension plans are still assuming, average rates of return going forward of about 7.58%. So if you look at that, the reality of it is we're in a world where government bonds are yielding, 2 and less, where even insanely overvalued stocks are yielding 3, where, you can't, even corporate debt, which is extremely risky at this stage because it also trades with the equity cycle. But even if you take on that kind of corporate risk, you're still looking at yields that are less than 6%, about 5.5% today. Again, because those assets are so overvalued. So there's nothing for it but to allow rates to move higher. And central banks should have done that 3 and 4 years ago. This is why they've painted us all into such a bad corner today, because they were so afraid of puncturing asset bubbles, in 2011-12 when global demand turned down, when asset values did deserve to have a mean reversion period again, because they'd spiked so hard off the bottom in 2009, they'd got ahead of themselves again. But instead of allowing that healthy readjustment to occur, they kept, gunning putting their floor to the pedal to the metal, so to speak, keep gunning the liquidity into the system and try and keep that going a little longer. And now here we are, at the next recession, at the next bear market, very likely in financial assets, and they are still near zero. So, of course, they're desperately wanting to get off the bottom in terms of interest rates, and I think they need to do it, but they're in this horrific scenario in their books because, they're supposed to be the prestidigitators that are, that command the entire business cycle by adding accelerant when you're in a recession and then, tightening when you're in an expansion to slow it down and all that good stuff. And here they are left without a single tool in their box because they have spent more money buying assets in this so-called recovery than they spent in any other recession prior to this period. And they've already hacked rates to the bone. So, that this is the mess they've made. And the answer is not try and keep rates, at zero forever. The answer is pay the piper. Let the thing adjust so that there's correct incentives put back into the system so people have a reason to save and pull back on risk assets which are not in their best interest to be holding, so that pensions have a chance, so that insurance companies have a chance of making their models work where they can, match their liabilities to their assets. I mean, these are all things that a civil society must have, and we have just gone loco, and we're going to pay the price here. There's so many productive things that need addressing, that, vital investment that needs to be made that is perfectly primed right now for where the world's headed and what's required, and yet we have wasted so much of our resources in these non-productive areas. So it's time to sober up. It's time to change the philosophy, get these mad people out of the helm, because obviously the delusion is so deep they will never come to their senses. They will continue to insist that their theories are right. It's just the measurements are wrong, or if the things aren't going in the direction they predicted, they just make some excuse about some unforeseen thing instead of just realizing that their theories were flawed to begin with. So even the IMF, came out this week with a revised target and warned, hey, the Trump administration's aggressive 3% plus targets of growth are completely unfounded in any kind of realism. And, they lowered their growth target for the U.S. to 2.1% in 2017, but that's already aggressive. The first quarter came in at less than 1.5%. I mean, this is the pace that we're at. This is stall speed, and anytime you get in that sort of stall speed, you have to say, okay, we're in the give back period. This is part of it. We have to be adults. We should have planned for this. This is what I've been trying to tell people for so long. It's part of the cycle, so plan for it. It doesn't have to be devastating and catastrophic, but if you don't plan for the winter, when it comes, you're hard hit, So it's kind of a frustrating thing, but hopefully one of these days, many people will clue in and start doing things in a more healthy way.
We'll have more with Danielle Park right after this.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Danielle Park. Danielle, I saw an article where people in Ontario, before they get into trouble where the bank is threatening to foreclose on their mortgage and so on, is they're going for economic counseling or seeking bankruptcy, trustee protection, that kind of thing. Are those people finally paying attention to reality and doing the right thing?
Well, you talk about a booming business, right? The insolvency and bankruptcy trustees are really in a booming business right now. They're going to have a steady flow. Now, yes, absolutely, that's an intelligent thing to do, and I've noted many of them that I follow or read their work are talking about people being proactive. So coming into them before they're, even behind sometimes, but they can see the writing on the wall. You're running as fast as you can and you realize you've only been making ends meet by going further into debt the past few years. And this is before we get into any job losses, right? Before we have this inevitable spike in unemployment, which comes every cycle. It's a normal part of it. So we are going to get that again. And even before that, you're having people defaulting. Defaults in the U.S. I was just looking at a chart of that. The default rate is already on subprime. It's already as high as it was during the 2008 crisis, and on every kind of consumer credit cards, consumer loans, auto loans, the whole thing. It is they're all increasing, and at the levels we saw is precursors to the last two recessions. So yes, you've taken on too much debt, and yes, people are correct to go in and get counseling. And in many cases, the trustee can negotiate a settlement, which is pennies on the dollar, literally, where you make a proposal for creditors. Look, guys, this is what I can pay, and here's what you're going to get back, and you can't get blood out of a stone. So, it is a very constructive thing for people to do. The flip side of that, of course, is that the lenders who have overextended and recklessly advanced funds to many people are going to have write-offs, because that's the other side of this. When they negotiate these settlements for pennies on the dollar, obviously it means assets are written down on the books of the lenders. So I think we should expect quite a bit more of that as well. We saw that in the 2008-9 cycle, and I think we would see probably even more of it this time, because we have that much more, overextended in the consumer sector and in the business sector. And the realty sector in Canada, the bank's largest exposure in their loan book is the realty construction sector, much greater than the oil and gas sector. They've really supplanted the one for the other in the past, since the oil price began to tank again in 2011, really, since it peaked and began to come back down, and then, it's had this sort of cascade rally and then lower low and lower low, but you've seen it pulling back. But a lot of the energy companies, again, I was looking at data on this, their debt is only actually coming up for renewal in 2018 and beyond. So we've kind of had a lull in the storm in terms of, people not looking for new financing as much in the oil and gas sector. I think that's going to change in the next 6 months and beyond. And, it's the reticence of lenders to advance more funds in that area. Meanwhile, they've got this other area that's blowing up as we speak, the household debt sector and their exposure there. So yes, I think people should take proactive steps. Keeping your head in the sand is not a solution. Mistakes have been made. Best to admit, repent, reform, and recover, right? This is the steps. They tell us if you do a 12-step program. First, you have to admit, repent, and then reform. Change your finances. Figure out ways to lower your expenses and to write off some of your bad debts and to start again. And so there's, that is the reconciliation process of bankruptcy. That's why it is an invigorating aspect of the business cycle. It's necessary because humans continually make these bad bets, both with loaning too much and borrowing too much. So you have to carte blanche, tabula rasa, and start fresh, and that will re-kick the next cycle. But first we have to get through this write-off period.
Did the banks make money anyway, even if debts are written off?
Sure they do. They make money in all sorts of ways. But, I think the thing that you have to appreciate about this type of cycle, when you have this much leverage and overvaluation and everything, you don't need a bank to go bankrupt, in order for its asset values or its share price to drop by half. In fact, if you think back to the 2001 U.S. recession. Technically, Canada avoided a recession of any kind in 2001. Our bank shares still lost more than half their value. The Canadian stock market still plunged by 50%. What it is you've got this, as I say, over-optimism on earnings momentum, expectation of perpetually, increasing earnings, and then all this fever around dividends, and news this week that the U.S. banks are going to go back to paying out huge amounts in shareholder dividends because they've passed these so-called stress tests. But that's just, again, the Federal Reserve's liquidity of the central banks that was pummeled in, that went into the banks, and now the banks want to call that money that's excess capital that they can return to shareholders. It's essentially all sleight of hand, because at the end of the day, once their assets start to get hit, once they start to have to value things for the proper at the proper discount on their balance sheet, once they're, the consumer goes into peril and they start having massive defaults, their profits get hurt. They have to take things out of reserve and note them as losses. And this all lowers their earnings expectations and lowers their reported earnings. And that's where, people lose faith and they realize they've overpaid for these shares in their peak cycle, and that now we see some of the mean reversion. And again, that can be up to 50%. And many people buy these shares thinking there's some kind of a conservative park where they can just collect dividends and go about their business. They don't remember, I guess, the last two cycles where they crashed by half, or maybe some of these owners didn't have them, or they thought it was bad luck, or whatever it is, but actually it's just a credit cycle. And when you've got such a rapidly accelerated credit cycle, you're going to have that kind of rapid shock on the downside as well.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Questions for the show or our guests can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of How Street Media Incorporated.